Here is a 60-minute chart. Okay, so the idea is you've expected the market to reach up into some kind of premium array. Okay, it should warrant a reversal of sorts, and you wait for the market to provide you confirmation. Okay, so up here on this high here, that very well may have been a return back up into an imbalance, like a SIBI being filled in, or it may be running on an old high when it's bearish. Maybe SMT divergence did not confirm this. And if you study it, you'll see that this here, on the hourly chart, we have a fair value gap here, a breaker there, and because we're trading inside of the breaker, this can be both a institutional order flow entry drill or a fair value gap. Okay, it just happens to be a partial fill to consequent encroachment here, but the breaker is really the main one. We're looking for the breaker to kind of like be the main catalyst here. So if you have a breaker that's bearish and you're expecting price to run up into it, just know that we probably won't fill in that gap. We want to see a little piece of that left open. And if you go through your notes, that's not just cherry picked here. It's also what I said in the past when it relates to fair value gaps or potentially institutional order flow entry drills with a breaker. Okay, breaker is kind of like the parent PD array. It's going to be more important. So it's going to draw back up into that, especially if it wants to pick up more liquidity. And that's obviously what we're showing here in the 60-minute chart. So the framework on the 60-minute chart is we expected some kind of bearishness. We have a market that breaks down here on this candle, takes out the low, and then we turn into a bearish breaker. And then with that idea, that run up into the bearish breaker also overlaps with the institutional order flow entry drill. That's what you're trying to see as an entry point. And you're looking at this low down here. What's the discount? Sell side liquidity. What's resting below that? Buy side imbalance, sell side inefficiency. So it's likely to rebalance here. Also target liquidity as well. So if they want to sell short here, and maybe they sold short here as well, obviously, with the benefit of hindsight, the market breaks down. We know that this is a likely scenario for another entry going short. So your framework is trying to get short here, selling short, looking to buy back below to the sellers below this low here, and maybe dig into this imbalance. Okay. On the 15-minute time frame, this is what it looks like. We have a market that breaks lower here. We have, again, a sell side imbalance, buy side inefficiency. That candle's low, this candle's high, consequent encroachment. Remember the likelihood of this not completely filling in on the hourly chart because of the breaker. So institutional order flow entry drill with the bearish breaker, you're going to sell short there. This happens to be the afternoon trend or session, 2 o'clock to 4 o'clock, and you'll find that on your own study of the E-mini S&P. I know some of you are like, can you just tell me where it is? It's important for you to go study it. Okay, if you're watching these videos on a more timely basis, preferably at the time I'm recording them and putting them up on the forum, it's going to be really easy for you to find this in the data. Okay, so this is a 15-minute chart. You can see we sold off from here. And again, targeted that imbalance that's over here on the 60-minute chart there. Now, the framework is a day trade to short-term setup. So you're looking at all these factors to provide the catalyst and framework for your setup. Some of you may look at this and say, this isn't really my cup of tea. This really isn't going to butter my bread. I don't like this one. It doesn't really resonate with me. Others in here may say, man, this is exactly what I'm looking at. I've been looking at this pattern for months. I can see it. This is making sense to me. So it's a matter of preference. It's a matter of what fits your personality, what PD arrays make most sense to you. They all make sense. They're all valid. They're all useful. But not everybody's going to agree on a framework that makes a setup viable to them. Okay, so for a day trade to short-term setup. Now, what's a short-term setup? Anything over 1 day, or in other words, holding overnight. Okay, short-term trade would be represented like that in my mind. A day trade is obviously getting out the same day you enter before the rollover into the new day. Framework is 60 minutes. Logic is it's likely to reach down here. The pattern of entry is here using time of day, afternoon session, if it's going to be the stock averages, which this happens to be. So we're seeing a breakdown earlier in the day, and then we have the 2 o'clock in the afternoon continuation, and then we have a break. Then it consolidates, goes into another new trading day where there's a retracement back up into a bearish order block, fair value gap. And if you're going to be doing short-term trading, you do not rush your stop loss and start trailing it down. You want to wait for a swing low, after retracement, because obviously we know that accumulation, distribution, and manipulation takes place with power 3. So if it's bearish, we're going to anticipate a market that may Judas higher. So you don't want to be premature about trailing your stop loss down if you're going to be using this model or framework for a day trade to short-term trade. So you can do kind of like a double tap scenario like I taught on Davey Pips, where one trade entry is used to take the day trade, and then the second portion is held, and then you look for it to drop down into your target, but you do not rush your trailed stop loss. You don't jam it down. You wait for it to present an opportunity to create a potential high of the day on the second day of the trade that you're in. And then once it delivers, obviously, you're out.